Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
And I'm Will Cunliffe, a Research Analyst here at Onyx Capital Group.
There's a busy week with lots of developments. We have lots of data coming up. The equity market in the US has made new all-time highs and the dollar continues to tumble. But what we did see at the end of last week was weak data, particularly consumer spending and consumer income.
Yeah, the housing data in the US was also similarly poor, and we'll also be looking at the Chinese PMIs as they beat expectation. And looking at commodities, we'll be analysing both Brent and gold as it continues to test its lower key support level.
If we look straight at last week's data, as I said, the big data was PCE inflation data, the Fed's favourite measure. That came in as expected, but it was secondary data that made the headlines, with personal consumer spending and consumer income both falling unexpectedly, which is a bit of surprise with consumer confidence. Well, that's falling as well, but with equities at new all-time highs, I think that's a bit of a surprise.
Yeah, I mean, it seems like we've started to see a bit of a convergence between the soft and hard data, you know. Powell talked about it time and time again that at the Fed, they were not that interested in the soft data. It kind of become de-anchored from the hard data. So a bit more of a convergence, perhaps in the way that many people hadn't have expected, with the hard data coming down towards the soft data. I mean, this is going to be a concern for some Fed members, but I think this is going to only split the committee. Powell seems pretty steadfast in his hawkish stance.
Do you think that this is a sign of convergence again, or is it a matter of a broken clock being right twice a day? Just because the two things are moving in the same direction doesn't necessarily imply causality anymore, does it?
Yeah, I think, well, this week we have huge data. We have the ISM, PMIs, we have payrolls as well. So we get to find out if it's actually filters through there. But as you can see from the chart here, personal income, that's turned negative. And you can see here, personal consumption. It's very rare they're negative, and these were unexpected. Again, consumers are hurting, and we can see that when we look at the housing data in a second. We can see that consumers are certainly under the pump. And of course, who benefits from equities at all-time highs? It's the top few percent.
The people who have invested and can afford to invest.
Absolutely.
Yeah.
Looking at the employment data, we obviously have key data this week, but if you look at continuing claims that came out last week, that's beginning to surge higher as well. So again, more soft data, secondary data, but it's all pointing in the same direction. The US economy is still pretty strong, although Q1 GDP came in negative.
Yeah.
But the economy is strong, but it's weakening.
I think these continuing claims are also a particularly worrying one. That's maybe the key long-run aspect of unemployment for an economy, because what you see is atrophy of skills within the labour force when they have, long periods of time outside the labour force. The skills that they currently have, their existing skill set, can atrophy, and also as requirements in the workforce change over time. You see more and more dependence on AI, etc. People are spending long times out of the workforce. That's really bad for their long-run productivity.
Yeah, what you're also seeing from the tech companies is AI is replacing jobs. That's from the tech companies. The non-tech companies, surely that has to be huge at some stage. That has to be worrying. Of course, over the weekend, we had some data out of China as well. So Chinese PMIs came out slightly stronger than expected. So that's a positive for China at least.
Yeah, it's been interesting on the Chinese data side, because for a while we've seen sort of bad news is good news, with the expectation that the PBOC or the CCP will come in with vast stimulus. We had a slightly more hawkish meeting come out of the PBOC last week, and they were basically saying that we can afford to not jump in with stimulus. China's economy is doing quite well. So then we saw futures on the 30-year CGB come off this morning, with the MBS PMIs printing a little bit firmer than expected on the services side. The market's almost gearing up for a bit of a smaller stimulus package coming out of China. So it'll be interesting to see how that materializes.
Brilliant. And also, if we look at consumer confidence, that came out last week as well. Actually, that one was pretty weak in the US. Previously at 98.4, estimated to come in at 99.8. It plummeted to 93. Present situation almost also fell from 135.9 to 129. Again, you can see from the chart, the market's moving in the wrong direction. Moving on to the Federal Reserve. You may remember 2 to 3 weeks ago, we had the last Fed meeting. It was seen as hawkish because previously 4 Fed members had expected no change by year end. Then at the last meeting a couple of weeks back, 7 Fed members expecting to be unchanged by year end. But now in the past couple of weeks, we've had 4 Fed members suddenly talking about possible cuts in July. Who have we had? Waller, Bauman, Goldsby, and now Daly. What's going on with the Fed?
I think, there's an element here of kind of trying to save face in a way. There's been deterioration in some data prints, and the Fed want to be seen to be reactive to that. I think, individual Fed members coming out and saying there's potential for a cut does not really change the outlook for Fed rate. It purely conveys that they're considering all data that they're seeing, especially at a time where the Fed is being criticised for being slow and for not being reactive. I think it's important.
That's coming from Trump, isn't it? Because the Fed has a dual mandate, growth and inflation.
Exactly.
And neither is a problem at the moment. If anything, the problem will be inflation creeping higher with tariffs, and they're less likely to cut. Yeah,
and Powell said at the last press conference, the pass-through has not been seen yet. They're seeing kind of effects of tariffs come through June, July, August. So data coming out for June should start to reflect that. But the previous round of tariffs from the last Trump administration, that saw kind of price pressures only materialize sort of 3-4 months later. And, we're still seeing continued effects in Europe as well of the tariffs. We're seeing backlogs at Rotterdam and at ports there. So we're only just starting to see that pass through now.
Yep. I rarely remember such a divergence of views on the Fed funds rate. Yeah. So what we have here is a comment from Bank of America talking about they think something's going to break in the economy over a summer, and they're talking about 75 basis points of cuts by year end. At the same time, I'm reading more and more hedge fund managers talking about no cuts this year. Such a wide range of views.
Yeah, and I think pure and simply as well, speaking about the environment in which Powell is left here, any action that he takes will be viewed as either, being clearly vehemently opposed to Trump and any of the pressures that he's putting on that, or suddenly caving into Trump and his pressures if he were to go in lower rates. And I think as a result, you basically almost get to this stage of inaction where you have to have a clear consensus coming from the data, because he's said now, month after month that he's going to be led by the data in any decision that's made. Unless the data on inflation or unemployment is clearly pointing to, a cut or perhaps even to raise at some point if the inflation prints start coming in, particularly badly over the next 3 months or so as tariffs pass through. And unless data is clearly pointing to one thing, I can very much imagine him wanting to keep interest rates very stable.
Yeah, I think he's doing the best thing. He's sitting with his hands, he's saying nothing. Of course, he's getting criticised by Donald Trump, but this is a committee. I forget the Fed, is it 16 or 18 members? But even if you replace Powell, it's a committee and their credibility is based on a dual mandate.
Exactly. And especially when that kind of, as Powell puts it, dual mandate's in tension. You have downside risk for employment at the same time as upside risk for inflation. When neither of those have materialized yet, it makes no sense to move in either direction. So I think higher for longer is going to stay until we get a realization.
Yeah, and we're going to see more stimulus coming through from this bill that's just been passed.
Exactly, that's going to be inflationary.
But the key data really becomes, it's Thursday actually this week, the payrolls, because Friday, of course, is July 4th holiday, but that's, again, key focus for markets.
In theory as well, there's this 9th of July deadline again for tariffs, which I think no one's really at the moment, pricing in too many surprises from that.
No.
But I guess definitely one to watch as well.
Bessink came out and said it's not going to be until the 1st of September now that people are going to actually agree on stuff. So it's been delayed and delayed and delayed.
Kick the can down the road.
Exactly.
Yeah.
Another interesting chart here. US manufacturing capital expenditure plans are sinking. Again, this has to be a huge headwind for US growth. But again, it takes time to filter through. We talk about what we think is going to happen in the markets, but we're talking about what we think is going to happen right now, but it takes so long to play out. If you look at the employment rate, unemployment, it's been creeping up for months, but we tend to look at markets and traders put trades on wanting instant gratification. But of course, that is a big problem with the markets. They're two different time frames, what the trader wants and expects and what actually plays out.
Well, I mean, this is, very reflective, isn't it, of, I think a couple of weeks ago, we were looking at CEO uncertainty as well. So you have consumer confidence being low in, a very politically choppy environment. You have CEO of businesses confidence very low. And of course, that leads to lower capital expenditure. If people aren't sure about what the economic climate that they're going to be investing in is going to be, they're not going to be putting their capital in these slightly riskier ventures.
Yeah, and it's also, there's uncertainties on the trade side with tariffs. There's also uncertainties on policy rate side. Which way is the Fed going to go? It's a very difficult time to be forward planning or trying to structure any sort of investment forward.
In which case, it almost becomes self-fulfilling.
Yeah.
Less expenditure, market slowly heads towards recession. We'll bring up the chart of the 2-year bond yield in the US soon, and that's in a similar downtrend to this. But we have inflation expectations continue to tumble, dragging yields on the dollar lower. You can see here consumer confidence from both the Conference Board and University of Michigan show inflation expectations falling. Sharp decline.
Still elevated.
It's still elevated. And what we're likely going to see now is it's starting to tick up with the tariffs.
Yep.
And on to Brent. So it's pretty quiet week after all the Middle East tensions we had sort of 2 weekends or last weekend. But Brodie.
So the main story with this was I think going into Sunday last week, Monday, as we were recording last time, there was still a lot of uncertainty as to what Iran's reaction would be to the US strikes with their B-2 bombers, etc. in Iran, and the retaliation was seen as ultimately a very weak one. So it was quite forecast. They, they launched missiles against American air bases in Qatar, in Iraq, but these were ultimately, in terms of the number of missiles used, not too numerous at all. These were weak attacks. So the market immediately, you can see that vertical line down on the chart there. The market just sold off immediately, looking at this, reaction by Iran as severely, as a severe sign of de-escalation in the region. Now, ultimately, this suits Mr. Trump very well because he's been demanding lower oil prices and lower product prices for a good amount of time. He was on Truth Social bleating on about we need to get oil prices down immediately, and as soon as Iran's pretty feeble response came through, that is what happened. And so we're now in this sort of $65 to $67 range. Slightly more volatile on the wings there, but that seems to be where we are now.
Where do you think this goes the next 2 to 3 months? Because I've been reading over the weekend that Iran will be able to enrich uranium again in 3 to 4 months' time. Is this a temporary ceasefire, do you think?
It's hard to say. I think that region in particular is volatile. I think ceasefires in the past have struggled to stick.
Israel's very hawkish.
Yeah.
I think it would take a long time for anything to materialise, though, in terms of an Iranian response. They look incredibly weak at the moment. They don't have their proxy allies sort of firing on all cylinders in Yemen or Hezbollah in Lebanon, etc. So their sphere of influence is being severely weakened. They need support from Russia or China if they're going to be going again, not only in terms of like hard responses, but in terms of military support for them. A lot of the missiles they're using and their warplanes are coming from Russia. If Russia is just occupied in this Ukrainian conflict, they're not going to be as willing to supply Iran. I think for the next 6 to 9 months, I can't really see Iran being able to mount that much of a response, particularly if they're going to be, restarting their nuclear programs. There's a hell of a lot of infrastructure that they need to be redeveloping, even if they have successfully redeployed their nuclear sort of fledgling arsenal, if you want to refer to it like that. So from a geopolitical stance, I can't see things re-escalating anytime soon, maybe 6 to 9 months down the line. But from an oil perspective as well, any rumours of escalation, I think, are just going to be met with more and more official party line OPEC run increases. So you're going to be seeing, a cap on crude prices, I would say here.
Also, with Donald Trump opening and agreeing that Iran can export to China, that's kind of opening up. He's looking to open up the economy more. The olive tree's there, the branch is there for them to negotiate.
Yeah, for sure. And the strikes on Bordeaux, I think it's been realised now that a lot of the nuclear material was actually removed from Bordeaux before the strikes, and then the retaliatory strikes, as James, you said, they were pretty performative, as Iran have done in the past. A lot of the retaliatory strikes have been of a performative nature. They were only using cruise missiles compared to, we know they have the hypersonic missiles that they've used against Israel. And Trump himself came out and thanked Iran for the pre-warning. It was seemingly very orchestrated. Yeah.
You saw the same in 2024, was it September or something, where, they basically phoned ahead to Israel saying, just make sure you're Iron Dome's on tonight.
And over the weekend as well, to minimise impact on the markets.
Exactly.
Yeah.
If we move on to US housing now, US housing's continued to wobble. Multifamily loan delinquencies are rising. And as you can see from the chart here, US new home supply has picked up sharply. As of June, up to 9.8 months of supply of single family homes. It's pushing to new highs. It's heading towards levels just before the financial crisis. If we move on a slide as well, you can see actual sales, home sales, about as low as they've ever been. And what's the problem here? Of course, it's mortgage rates and consumer confidence. It's that low. If that's low, you're not going to be buying. One more chart here. Here's loan delinquencies. They are surging again, levels last seen towards a financial crisis. Again, this is a perfect example of a market that's just very slow to play out.
Yeah.
I think in terms of home sales as well, you do have the general squeeze. Obviously, the avenue that makes itself abundant in home sales is if people are facing rent prices that are constant / ticking up, especially as a percentage of their sort of take-home wage. They have less money to put towards things like deposits, etc. So I don't think we're going to be looking at particularly strong home sales at any point soon.
But this potentially has a huge problem for the economy. We've seen what happened in China. If house prices are falling, that's where people have a lot of money invested. If people get into negative equity, they reduce their spending, of course. Retail sales fall, hits the economy, becomes a vicious cycle. How does that play out? I mean, where do you think this goes in 3 to 6 months?
I think it depends on what we get out of the Fed, and then how responsive mortgage rates are to that. We're seeing MBA mortgage applications are they're pretty choppy, but they're ticking along relatively steadily.
But sales are falling.
Yeah. So I think it's difficult to be optimistic about the housing market. I don't think it's a concern yet. I mean, we had a lot of questions last FOMC about the housing market, and Powell reiterated that we're not at a 2008 level yet. there, but it's definitely trending in the wrong direction and absent from Fed cuts. And especially if those Fed cuts lead to a steepener in the curve, for example, and the 10-year doesn't actually move.
I was about to say that the Fed cuts is the front of the curve.
Yeah.
And what we've seen after last week's discussion, the curve is steepening slightly.
Yeah.
It went from 46 points to 53 today.
Yeah.
Slight steepening. But if the Fed cut, it actually could make mortgage rates go higher, because if the curve steepens.
Yeah. I mean, we could see that for sure. I think it also depends on, how the market responds to the fiscal situation in the US, which with Trump's new tax cuts coming through, reduced tariffs, it's not looking good for US debt sustainability.
And that could be a real problem, because if we see we keep mentioning the 30-year, I think it's at 480, about 480 level, but if it gets to the 518 and goes above there, then the market's going to be out of bonds, get out aggressively.
Yeah.
Yields, the long end will go much higher. That's going to be really painful for mortgage rates.
Yeah, definitely.
And the housing market.
Yeah.
And if we start to see unemployment going up as well, that's typically when house prices fall, because when people are forced
to liquidate,
yeah, that's when the problems really happen. But let's hope we don't get there.
Yeah.
The UK Bank of England's Bailey has turned more dovish. He said, we are starting to see labour markets slowing. Here's a chart of the UK 2-year yield. You can see it's trending lower again. The last low there, start of 2000. Actually, no, that's sort of a middle of 2024. That's at 3.4%. Then the previous low is 3%, but it's trending in that direction. But we're seeing across the board now, we're seeing yields heading lower. And onto equities, the S&P and the Nasdaq have made new all-time highs this week. And overnight, actually, Canada's rescinded its digital services tax on the US tech companies. So we're seeing more equity futures ticking up off the back of that. We've said equities are expensive. If I just tick on one more slide here, you can see just how expensive equities are, their historical norms. The third one in the middle, the S&P 500, forward PE of 22 times. That's as high as it's been. The equity market, it's the price action. It's going higher, so you can't fight it.
Yeah, and I think as well, the one that's interesting to my mind is Nasdaq seems to be leading the S&P at the moment. So I think year on year, S&P's up 4%, Nasdaq's up 5.5%. This despite all this horrific tariff stuff and uncertainty that threaten to really burst the bubble of the equity market. So to see these tech companies just going from strength to strength in terms of stock price, despite earnings not necessarily indicating the same strength. But yeah, to see that stock strength continuing, this is an upward trending market.
If I push on to bonds as well, here you can see the US 2-year yield. It's targeting a 3.42 support, but you can see this is going back to COVID, this chart. You can see just how big a move we've had higher. You can see we're getting pretty close to the support. If that breaks, and of course it's going to be weak data that would see that go lower, then you'll see people buying bonds. This is the front of the curve. Important to stress that, because it's the back of the curve that people don't want to touch with these debt concerns. But to me, it looks like that's going to aim for this 342 support. And if that breaks, then it's going to be off to the races. It's going to be self-fulfilling. The market, all you'll hear is about data weakness on buying at the front of the curve. Any thoughts on that one?
I think, it will create room for the front loading of issuance as well. So I think the downside could be capped, just because Trump will obviously have a massive deficit that he'll need to fund. Do you issue a 10-year maturity at 4+% or at the 2-year? I mean, we saw that last in the Biden administration, where a lot of that issuance was front loaded and a lot of the maturity was brought forward to the 2-year. So it'll be interesting to see if that kind of limits any sort of downside move here. But yeah, it definitely looks like it's trending down.
And onto the currencies. Here, the dollar's continued its downtrend. You can see from the chart here how the correlation with yields has completely broken. So people basically, they don't want the dollar, and they're not wanting bonds either. This is the 10-year yield. That correlation's completely broken. And pushing on, you can see dollar yen. Now, we talked about the 140 trendline support. Well, last week, or when we had the Middle East troubles, inflation spiked, dollar yen briefly burst higher, but now you can see it's back targeting that 140 support line. Again, I think it's going to head there. Week data will get it there quicker. But a break of that, you'll see that all over social media, that trade. People will jump in. But the longs have their stops just below 140. And those that want to go short have their trade entries at just below 140. So that's why you get these sudden moves below key support. A break of 140, it'll move aggressively lower.
Yeah, and if you see, Japanese interest rates rallying as well, that's going to be an immediate, drop down, you would have thought, and that would stop out any of the longs in that scenario. But obviously, these currency trades can put reverse pressures on governments as well, as I think, as we'll discuss with the ECB, they're going to be having to scratch their heads a bit as to what to do and how much they have to cut because of the dollar weakness that consequently inflates the euro.
Yeah, we have that chart next.
Yeah,
and this is the euro dollar long-term chart here, but you can see how it's trending aggressively higher. Again, that's what we got here. It's painful for ECB to watch. It could go a whole lot higher, but they don't want strong currency.
Yeah.
Onto commodities, gold. That's bounced this morning. You can see bounced perfectly off a support line. I love trend lines. I love moving averages as well. Again, the dollar's weaker this morning. Gold's bounced. Key support would be this morning's low, I guess, of 3,248. But when we're going higher, we'll look to test that. It's not quite a perfect triple top, but you can see 3,450. Looks like the market wants to test that. And we keep saying we have central bank buying that supports this. Any concerns about US debt, that supports buying this. Inflation concerns. Yeah. And we've seen retail traders in China are aggressively buying as well. Yeah. So
we've seen other precious metals kind of rally off the back of the gold sell-off. So that'll be putting upward pressure on gold again now.
Platinum's had a huge uptrend, but the volatility is incredible. Yeah. I mean, the daily ranges are massive. Yep. Not for the faint-hearted, but it's in a massive uptrend. It's going up far more aggressively than both silver and gold.
Yeah.
Onto hedge funds. Hedge funds are cutting length here. Will, what's happening here?
Yeah, so we've seen managed money cut length in WTI and Brent futures this week, which is hardly surprising. There'll have been a lot of stop outs for the longs. We've seen CTAs reverse as well, so they're now net short.
This is Brent.
In Brent and WTI futures. So yeah, it was to be expected. The market was very long going into the sell-off on last sort of Monday, Sunday night. So now seeing a kind of retracement as funds stopping out is been pretty aggressive.
But funds are really struggling, aren't they? Because they were short when we had this Middle East crisis. The market went up aggressively. They were long when it sold off aggressively last week.
Yeah.
They've been burned badly.
Yeah, some of them have. I mean, some of them have done very well. We heard about in April of one fund in particular kind of loading up on call options, and they've done pretty well. But yeah, I think a lot of funds have been burned. I mean, one in particular was Andurand. It was reported they're now down about 60%.
60%
year on.
I mean, he's had a fantastic career, but the last couple of years have been
pretty tough.
Pretty tough. Yeah.
First 3 weeks of July, I think, down 12%.
Over 12%.
June, sorry. Because he had a particularly rough start to the year as well. His fund was down about 37% year on year, which in like March or April, which I think a lot of that was purported to be his ultimately long bias on Brent and a number of oil derivatives. But he's also, I think he made a lot of money in 2024 on this cocoa trend. Yeah. But I think that hasn't been performing quite as well. So yeah, it seems very tough. And then obviously the volatility, volatility's been back in oil, and you've had like $16 ranges in crude over a 3 week period or something. Yeah. So whilst it some firms ultimately might be able to pick the tops and pick the bottoms very nicely. You'd have to have a really good magic ball to be able to do that, and you can lose a lot of money on a $16 move either way.
Yeah, especially when it happens over the weekend, because you can't move in and out your position. You go home Friday, you come in Monday.
Yeah, I think that's an important one to note for the viewers, because of course what we saw both Sunday night on this last week just gone, and the Sunday before is on escalation headlines over the weekend. You see immediate buying coming in, and then as soon as any buying comes in and gets wiped out, it sells off pretty aggressively after. So you actually saw, even before the retaliation by Iran, you saw Brent trading up to like $82 in the sort of late night Sunday, wee hours of Monday morning. And then it sells
$5.
Yeah, and you ultimately have a red candle over the sort of six hour period, because and this was the same case the Sunday night before. Yeah. So people come in, and you despite having a lot of the information leading to like bullish sentiment, you see red candles.
Yep. Yeah. You've seen it before as well in the crypto markets, where crypto several years ago, it was a May, I remember that, I don't remember which year exactly, but Bitcoin and Ethereum, they all sold off about 33 to 35% over the weekend. Now, if you're trading on the crypto exchanges, for whatever fraudulent they are, you could get in and out of your position. But if the people that are trading futures or CFDs, you're sitting on your hands till Monday morning, and that's a pretty painful one. On to the OIS pricing. So what's expected from the central banks? The Fed, 110 basis points over the next 12 months. By year end, that's suddenly gone from, I think it's 66 basis points last week to 88, which hadn't seen a huge move last week. ECB, just 27 basis points of cuts. Again, I tend to think we're going to have to see more from the ECB, with signs of more disinflation there as well, plus the constraints of a stronger currency. Bank of England, the market's pricing more dovish, more cuts, 81 basis points. And big one, RBA, still 96 basis points of cuts priced there. We have a meeting on the 8th of July. Market's pricing exactly 25 basis points of cuts, but there are some economists there looking for a chance of 50 basis points. BOJ, market's still expecting hikes there. And that, if anything, favours the dollar-yen currency lower.
Yeah.
Couple of extra charts. Tesla, it launched its robo-taxi in Austin. The market jumped 10% on that. I've been a big critic of Tesla, but one thing's come out of this. Rides are capped at $4.20. That's extraordinary. I don't know if you get a taxi recently in London or outside London, but
yeah, this is a classic. This is a classic Musk gimmick, though, and ultimately that will rally to $6.90 per ride before long, and then regular market forces will have to be back in place. But
if you look at the chart, actually, the chart to me, that's a nothing. Don't buy, don't sell. It's not an uptrend. It's not a downtrend. Sideways trend, and trade the break.
Yeah.
Whereas the flip side, if we go to Nvidia, this one, and the other important point actually with Tesla there, it's going sideways while equities are making new all-time highs. So actually, if anything, that's weak.
Yeah.
But Nvidia here, you can see new all-time highs. We talked about there being a double top. That would be resistance. Well, it's broken through there, which means new buying comes in. The shorts have to cover their shorts, and new money comes in to buy. So Michael Burry's not particularly happy with that. That's his big position, short via puts. But that's clearly going up.
And interestingly, Jensen Huang apparently is selling his equity again after a quarter of not selling any. So even as we're breaking all-time highs, we're seeing insiders kind of selling their positions, taking.
And we see traders love buying these breaks because it becomes an easy risk reward. You go long, you have a stop just below the previous highs. You see this from the turtle traders, you see this from Darvas. Common trading strategy. You're going with momentum, you're buying your all-time highs, you have a stop nearby, and you sit on your hands and watch yourself make money. Sounds easy. On to this week's data. A lot of data this week. Tuesday, we have US ISM manufacturing PMI. Powell speaking, we have the JOLTS job openings data, and in Eurozone, we have PMIs and CPI. On Wednesday, Australian retail sales, US mortgage applications, again taking on more significance, and ADP payrolls. Again, not particularly well correlated to the payroll number, but it gets a lot of attention if it comes in unexpected. With Friday being the holiday, Thursday is the big day. US payroll data, also ISM services PMI and initial jobless claims. So actually, it's by far the biggest week of data. We have the Middle East tensions behind us. The debt concerns are off the table for now because yields are coming lower. So it's all eyes on the data, and Thursday's the big one.
Yeah.
Hopefully you've enjoyed this week's Macro Monday. Good luck this week. Lots of data to keep an eye on, and see you next week. Thank you very much.
Thank you.
Thank you.